Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Again, M&A talk just kind of coming across the tape here. Boeing in talks to buy supplier Spirit AeroSystems. Spirit AeroSystems stock is higher, Boeing a little bit lower here. But, one could argue this is a transaction that probably needs to happen for Boeing to address some of their concerns. Well, let's bring on George Ferguson. George Ferguson covers the aerospace and airlines business for Bloomberg Intelligence. George, tell us why Boeing would want to do this transaction.
Good morning, Paul. Quality control. It's absolutely quality control. They must be looking inside Spirit. I know they've been looking inside Spirit for months. My guess is they've looked inside and they just feel like they can't control quality well enough as an outsider. They used to own Spirit, not as it looks exactly now, but they used to own, those facilities. It makes a majority of the 737 fuselage. It makes the front portion of the 787. Two extremely important products. I think they've looked inside and they said, we can't control quality well enough from the outside. We got to buy this thing.
Do we trust Boeing to have the kind of quality control that Spirit needs?
Boeing doesn't have a choice. Boeing's got to get quality control or they got a major problem on their hands. And so I think as an owner, I think it is the path, probably a good path forward. I do think they will get the quality issues in hand, but it's going to take some time. But they have to. They have no choice.
Yeah, I'm looking at the stock of Boeing, pretty much unchanged on the news here. If I were an investor in Boeing, I would think it may or may not make financial sense to own this Spirit thing, but I would say it's probably the best way to move forward here. And when you talk to investors, George, did they think that way?
I think investors, I don't know that you could say they all monolithically think that way. I think if there could have been a way to keep it outside, not have to buy it, I think that probably would have pleased people more. I mean, there will be an unwinding required in this transaction, right? So Airbus's A320, some of the components are made at Spirit. I'm imagining that Airbus is not going to be interested in having, Boeing as a subcontractor on their airplane, and there are other defense products, for Lockheed and things like that. It's going to require some work to unwind this thing a little bit in order to pull it inside of Boeing. Probably energy you would prefer not Boeing to spend, but again, I think it's their most important products are flowing through Spirit, and Spirit's been a source of the problems in some of those products lately. And if Boeing is going to much higher production rates, which is where they're going to generate the cash flow they need, the profitability they need, they've got to stabilize production. And I think they must have looked at it and said, we got to own it. And so if you're an investor, I think you're okay. Yeah, it's the way forward. I'd rather not have taken this path, but it's the way forward.
This is a leading question, and it could be very wrong. But does this tell us anything about how bad things are at Spirit, that this is the option?
I think it does.
So how bad are things at Spirit?
To me, it sounds like it's so bad they got to buy it. And I think that's bad, right? If you're Boeing, you do want to preserve cash, right? You don't want to go make an acquisition. You got plenty of other things to manage right now. But I think it means that, yes, the turnover at Spirit's been bad. The quality control, I think that's led to the quality control problems. You want to have your hand in how those line workers are being managed, how the quality control is being handled. I think it means it was really bad at Spirit.
All right, the shares of Spirit AeroSystems, SPR is the ticker for your Bloomberg terminal, up 14% year-to-date. Trading has resumed here. So obviously the market signing pretty high probability that something will get done here. So George, just looking at Boeing holistically, as you've told us in the past, this is a scale business. You got to make as many planes as you can for that over that fixed cost base you have. Talk to us about the production goals, or talk to us where they are in production today and where do they want to get to? And do you think that's a reasonable glide path?
So they are at 38 today, although they'll tell you even though their suppliers are building at 38 and delivering to Boeing at 38, Boeing's not putting 38 out. So I don't know. They're somewhere between. They're somewhere in the high 30s, let's say. Depends what month it is.
That's on a per month basis, just in general.
Sorry, and that's on the 737.
Yep.
That's their most important product. On the 787, we're in the I think 5-6-ish area right now. On 737, they've got goals to be into the 50s. They've and at the end of the last expansion phase before the pandemic, before the MAX crashes and groundings, they were in the 60s. They're not going to go to the 60s. Airbus is, for the 737, Airbus is talking about going to 75 for the A320. So I think if you and I were inside the Boeing management meetings and they told you where they really wanted to go, they want to be up there near Airbus, taking a 50-50 complement of this market. Is that the right place to go? Yes. They're talking mid-decade. Yes. Probably pulling Spirit inside. Timing probably had a lot to do with that too. They thought, look, how can we stabilize this the fastest? Because we don't want to keep giving away share to Airbus.
Going to Spirit, back to Spirit just for 1 second, we're also reporting that Spirit is exploring strategic options. So that leads me to believe that if the Boeing thing doesn't happen, they're still in deep trouble and they got to get a buyer or do something else. What would be plan B?
For Spirit?
Yeah.
Yeah, I mean, when we look at Spirit's, Spirit has a bunch of debt coming due. The capital markets haven't loved them as much. I think that some of the debt they've placed has been up in the 9%-ish levels. I think the debt capital markets especially, have looked at the Boeing relationship, and that's given them more comfort, probably to give them rates that perhaps were better than what Spirit should have got. I think it, frankly, would be strategic options, away from Boeing are really difficult because, again, some 50, 60, I'm talking off the cuff here, I'd have to go pull the exact number of their revenues flow through Boeing. What I'm guessing, and that strategic comment, is that Spirit is probably looking at how they would spin off portions of the business that are not Boeing focused, so that it could continue, to serve those customers. Like I said, Airbus, Lockheed, other defense companies have products that are being built by Spirit. I think they're probably looking at ways to continue to service them in an entity that would be outside of Boeing. The fuselage building business, which is largely what Spirit does, isn't one of the great money makers in the industry. And, we've seen it go to some, to go offshore. The Koreans want to be in this business. The Japanese are in this business. The Chinese are in this business. There's a lot of competition in that space. And so I think it makes it a really hard part of the business to be in, to make very good returns. And look, it's a space, the fuselage building space, that I think Airbus has kept more inside because, again, they want to control the quality. So, I guess that's a long way of saying I don't know that options as a complete entity away from Boeing, I don't know that great ones exist, and I don't see that. My guess is they're trying to spin parts of it away.
All right, George, thanks so much for joining us on short notice. Really appreciate it. George Ferguson, he covers the aerospace business as well as the airlines, the whole complex over there, including the defense manufacturers. Wall Street Journal first reported, now Bloomberg News matching, that Boeing is in talks to acquire Spirit AeroSystems Holdings. SPR is the ticker. Spirit is, the stock is up 15.5% today right now. So suggesting that the market believes that there is something there. And as George was suggesting, Alix, it's probably something they got to do.
George was awesome.
Yeah.
That was great. That was great perspective, etc. Yeah, and I thought that it was really interesting that it's the fuselage business. So if you can spin off other stuff, maybe that's the profitable moneymaker. You can still keep the contracts with Airbus and Boeing, but it's the fuselage business. That's the part that Boeing just has to basically absorb and suck up within its company. We'll see if that works.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
New York Community Bank down 20%. All right, you know the story. It has discovered, quote, material weaknesses in how it tracks loan risks. They wrote down the value of the company it acquired years ago and replaced its leadership to help grapple with the turmoil. There was a theory that maybe this kind of risk was idiosyncratic. They are one of the big exposures to rent-controlled apartments here in New York City that has been hurt by a revamp of some of those rent control laws. So when there's a banking potential crisis, we go to one guy, Herman Chan. Bloomberg Intelligence Senior Analyst for U.S. regional banks. Herman, can we still call this idiosyncratic?
It is a good question. I think it's the appropriate question. What's idiosyncratic is, you mentioned the exposures to commercial real estate, specifically apartment lending and office. But what's also idiosyncratic is that it recently cleared the $100 billion asset mark, which ushers in higher capital, liquidity, regulatory issues for the bank. And what's happening in our view is that it's easy to reach the big leagues of $100 billion. It looks like it's harder to stay there, right? And what we're seeing is that they're facing growing pains and becoming such a bigger company, and these lack of material weakness in internal controls just reflects that. Change
in management, is that usually doesn't look good.
Right.
I guess that's contributing to the stock here today, but tell us about that.
Yeah, sure. So a few years back, the bank acquired another institution called Flagstar Bank, and the CEO of Flagstar Bank is now the CEO of NYCB. He was named the executive chairman earlier in February once these issues became apparent, and it looks like the former CEO just has been sidelined because of the need for new management.
Okay, so what's interesting is that if we rewind to when they were able to buy, was it Signature?
Right, correct.
Some Signature assets, right? It was like, oh, look, yay, they were the savior, etc. Is that are regulators gonna rethink what being a bank savior is in that circumstance?
Yeah, that's a great question. And I think it really poses a different question. Was New York Community the right bank to acquire the Signature assets and deposits? If the regulators should have known that New York Community wasn't really up to speed on a number of these internal issues, capital issues, liquidity issues, and reserve issues. So, do the regulators need to be more cognizant of what they're doing and anointing a potential savior, and a year later, now this bank is in the crosshairs?
One of the lessons I take away from this story is, I think, a basic fundamental investing lesson, which is kind of concentration risk. Look at the company. Here's had so much exposure to this type of loan class, i.e. loans to rent-controlled apartments. Right. That presents a whole level of risk, i.e. they're not diversified in their portfolio as much as maybe we would like. But I guess if you were an investor in NYCB, you knew that going in, right?
Yes, you knew that going in, that this was the bank that has historically focused on the rent-regulated apartment lending sector. They're the big kahuna in this niche business, and they've been doing it for decades. So that's not new. And you should have known that a few years back when New York imposed tougher rent regulations, that this was going to hurt their main business. So it's taken a few years for this to really bore itself out.
Also, maybe an investor should have known, but the company also should have known. That part couldn't have come as a surprise from that end.
No, but their risk and controls, that's a real problem.
Exactly. And now they're trying to do, what is this, synthetic risk something? What are they trying to do?
So basically they're
Anything
doing
with
this
synthetic sounds not great, but
this,
what do I know?
Synthetic derivative transaction to help reduce their loan exposures and improve their capital. So it's one way to get rid of or improve their capital without actually selling the loans.
All right, for our listeners and viewers that are not exposed to New York rent-controlled real estate. Talk to us about just the regional banks in general. What's kind of the feeling when you talk to investors today? Are they warming up to this sector? I know it's bounced off that October low.
Right.
But I'm not sure if that's a market bounce or people are saying, all right, I think I've seen the worst in regional banks.
It's an interesting question. You're right that they've bounced, but now a number of folks in the market are saying potentially no rate cuts this year, which would be viewed as negative for the regional banks, just because deposit costs have risen.
But no rate cuts because the economy is good and accelerating. Right. So wouldn't that be good?
There's two things that weigh on that. Number one, there's not a lot of loan growth, and rate cuts would improve loan demand. And number two, elevated interest rates is bad for credit quality and being able to refinance the existing loans, and the decline in value in areas like office commercial real estate could hamper banks' credit quality.
So where are we on that commercial real estate risk? I kind of feel like it's a time bomb still out there.
Right.
And at any time over the next 2 or 3 or 4 years, maybe multiple times over that time frame, we're going to have Bank A or group of banks that are going to call out CRE as a reason why they really missed, or they have to really up their reserves or something like that. Where are we on that?
Yeah, that continues to play out. We saw that with New York Community in the fourth quarter. We'd expect more of that going ahead in the coming quarters. That being said, the risk in our view is really relegated to the smaller banking institutions. We just looked at some data, which I think was pretty interesting. Since the COVID era, and starting in 2019, the top 25 U.S. banks have grown their commercial real estate loans by only 2%. Okay. And then the smallest banks have grown their commercial real estate by 43%. So that shows me that really the risk is comprised largely in the smaller bank cohort.
That's interesting. So let me ask a question going back to the Fed cut. So if we don't get a cut for this year, let's just pretend game out.
Did that just come with Torsten, or other people talking about?
No, it's just Torsten, I think. I think a couple weeks ago people were talking about the worry that we may have to have another hike because inflation was reaccelerating, but this is maybe the first I've heard of no cuts at all. So if that happens and there's no cuts, who's going to be under pressure? I mean, you mentioned the fact that a cut would help loan demand. So who's already seeing sketchy loan demand?
Right. So that's an industry phenomenon where we're not seeing loan growth across the group. The Fed puts out weekly data, and it shows that loans are down, quarter to date in commercial loans. So that's a big driver of the regional bank, the large regional bank balance sheet. So that's hampered. It's going to affect banks like probably New York Community the most, because any potential rate cuts would view as a savior for them, because then their borrowers could refinance at lower rates.
All right, Herman, thanks so much for joining us. Herman Chan, Senior Analyst for the banks, joining us here in our Bloomberg Interactive Broker Studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
This is the Bloomberg Intelligence Radio Show, where we bring you great analysis with all our Bloomberg Intelligence folks, 2,000 companies, 130 industries. You want to know about it, they cover it. We also like to give you a perspective of how to invest on a broader level, particularly on a day where the data might point to maybe we're going to get some Fed cuts, but then Torsten Slok of Apollo said you're not going to get any cuts this year because the economy is just actually accelerating. Things are too strong. So Anna Rathbun joins us now. She is CIO at CBIZ Investment Advisory Services. Anna, do you agree with Torsten Slok maybe, or what's the case for no cuts at all this year?
I don't know about no cuts, but I think it's certainly difficult for the Fed to raise rates at this time, or at least looking out into 2024. And it's not just the inflation, it's their target of 2%. It has been really sticky. Sticky doesn't mean it's not falling. Sticky means it's falling very slowly and that it's very, very bumpy. So either the Fed is going to have to accept a higher than 2% inflation rate and call it maybe the momentum is heading down and start to normalize rates, or they may have to be higher for longer. That may be one cut, maybe two cuts, maybe no cuts. But I think no cuts is that's a pretty hawkish view.
Well, he's certainly got some airtime, if nothing else, today. Anna, what do you think about this kind of soft landing scenario that seems to be out there? People kind of feel like maybe the Fed's doing a pretty good job here negotiating a soft landing. Do you buy into that?
Well, I think you have to look at the underlying risks that are in the markets. I mean, there's the labor market, weakness in the fringes that we've seen. And this is sort of like, what would a recession look like if we didn't have external shocks? If you think about the last 3 recessions that we had, they all came from crazy external shocks. How often do you have a pandemic? How often do you have a global financial crisis? Maybe there's a tech bubble. I don't know. Depends on who you ask. But that was in the late 90s. These are sort of triggered by outside factors. If you have a normal economic cycle where you really have like a natural boom and bust, you're going to see weakness around the fringes. And I think we're starting to see that, and in the consumers, labor market, as well as delinquency rates, et cetera. And you're starting to see some cracks in the markets, especially with New York Community Bank, right? I mean, that was news that came out. We started to see some cracks about a year ago. It's almost a 1-year anniversary. And here we are in 2024 talking about banks again.
So would that be a call then to sell the rally in small caps? Because what you're describing is really great for large cap companies and really bad for the small guys.
Well, I mean, I think the small caps have been telling us that it's been pretty uncertain. Because
but they've outperformed, Anna. In the short term, they have outperformed.
Yes. So short term, they've outperformed because the yields came down, right? So if we're talking about a higher for longer scenario, I mean, look at the 10-year today. It's falling pretty dramatically, and yesterday as well. I mean, small caps tend to like these things. But if we're talking about a higher for longer, we're talking about a pretty volatile rate environment where it can definitely go back up. And when it goes back up, it sort of supports that higher for longer narrative. And that's not as friendly for small stocks.
How about on the fixed income side here? I'm looking at, just the 2-year Treasury, for example. It's pulling back today off of 7 basis points, but you're still getting north of 4.5% for a 2-year. How do you kind of advise your clients to think about the fixed income space?
Well, so depending on why you're investing in fixed income, I think that reason is very important. Look, I mean, yield is very, very attractive. And so even if you have some sell-off on and some headwind on the price, there's enough yield there to cushion some of that blow, so that we're not talking about the same environment as before the Fed started to raise rates, right? So we're less sensitive to price changes. So we do invest for yield, especially on the shorter end. And we are keeping duration a little bit on the shorter side because of some of the volatility that we were expecting on the longer end of the curve.
So is that a steepener trade then?
Yes. I mean, we're not.
Paul doesn't like that. He doesn't like to talk about steepeners. But because the steepener trade has been real rough.
Oh, yes, it has. And I think that's because every time the Fed comes out and says, well, we're thinking about cutting rates, we're thinking about doing this or that, I think the markets interpret that to be, okay, the Fed is going to be dovish, and the financial conditions loosen, and then it tightens again. I think it's that volatility that's very hard to stomach for some of our investors. So keeping duration a little bit on the shorter side to minimize some of that price impact is sort of our goal.
How about in the credit space here? Should I be willing to go out there and maybe take some credit risk in an effort to maybe goose up my yield here?
So we're talking about credit spreads, or are we talking about treasury yields? Because the treasury yields are very, very attractive. And of course, you put the credit spreads on top of that, it's even more attractive. But we are a little bit more careful on credit, especially on high yield. I believe our high yield is at the lowest that we're, in terms of percentage, that willing to go. It is still a very attractive yield. Again, there's some a cushion for some of the price volatility. But when high yield spread widens, that widens pretty quickly. There's a big price action there on the negative side that we don't necessarily want to participate in. So we're staying on the investment grade credit. As we all know, that market has been very, very healthy in terms of new issuance, in terms of demand. And so we are there at the moment. I can't tell you that we'll be there next month, but certainly for now, we've been clipping very nice coupon on that front.
Okay, so that's a good point, because you're in the investment grade market, but that's for the coupon. In the treasury market, mm-hmm. Are you there for price appreciation, or are you there for the coupon?
We're there for the coupon because, again, rates are so volatile that we sort of have to ignore it as noise for the time being, and we're there to clip the coupon. So we were there for a while now, especially after, let's say in 2023, about halfway into 2023, we increased duration, we increased our fixed income exposure to participate on that yield. And a lot of our clients are actually looking for that yield, so that made sense for us.
So Anna, the issue here is for a lot of folks is, what is our Federal Reserve going to do? And, again, there's a lot of competing calls out there, but overall, where do you think the risk profile for this market is? Do you think people are willing to take risk when you talk to your clients, or are they a little bit more risk adverse?
It's mixed. So there's definitely FOMO, but there are people who, especially small business owners, they see some of them see strengths, some of them definitely see weaknesses, and a lot of them tell us that this market doesn't make sense to them. So what is priced into the markets right now is a lot of optimism, including scenario where Fed starts to cut. And if that doesn't materialize, I think that the markets may be in for a surprise. And a lot of our clients are definitely thinking in that way. The valuations, the numbers don't sit very well with them. So certainly there's some fear, but there's always a push and pull between FOMO and fear, right?
Yeah. I definitely have some FOMO, but I'm also like soup cans under my bed kind of gal. So Anna, thanks a lot. Really appreciate it. Anna Rathbun, CIO at CBIZ Investment Advisory Services.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We did see, Paul, a spike once we got the ISM and the UMISH in the S&P. Like, I get we're only up 1/10%, and definitely buying coming into the front end. It's like, buy everything. It's okay. The Fed's going to cut. Not at all what Torsten Slok was saying.
No, Torsten Slok, we just had Torsten Slok on saying the economy's better than expected. Well, these numbers don't show that.
They don't. So let's kind of understand what's going on. Tim Fiore is chair of the Institute for Supply Management. So he's the ISM guy. So he does all the stuff. He does all the surveys. He knows the things. And just to recap, ISM manufacturing coming in light at 47.8. The new orders, though, slipping below 50. All right, Tim, what happened? What's going on?
So, Alex, it was actually a pretty good month. So what's actually happening on the number side is seasonal adjustment factors. So we got a huge benefit in January from seasonal factors, and we got a huge deduct in February from seasonal factors. If you look at the raw numbers, we're actually positive in February compared to January, which you would normally expect to see anyway. So overall, I go through the 10 sub-indexes. I categorize them as positive, negative, or mixed for the month, and I determined all of the sub-indexes were positive for the month. So let me support this whole thing on the demand side, because the new order number is the one that's going to really flash out at people. By far, the majority of our comments around softening demand is decreased in half. So many fewer panelists are commenting about softer orders, which is a positive thing. Our sentiment around future demand is still running at about 2 to 1. We peaked at 10 or 12 to 1, many months ago, but 2 to 1 still says we have a predominant amount of people saying that things in the future are going to get better. I've been tracking the percent of respondents that are below 50 industry sectors and the ones that are below 45, which is a real warning sign. So I think last month under 45, we were 27 back in January, 27% of manufacturing was contracting at 45 or less. This month it's 1%.
Wow.
And then on the overall contraction under 50, last month was in the range of 65. This month we're in the range of 40. So overall, we're moving in the right direction. This is going to be a slow recovery. I think the month of February indicated that, yes, January was a pivot month. We're starting to grow again. The headline number isn't showing that, but the detail underneath supports it for sure. So I think demand is coming back for sure, especially with the raw number being up.
Okay. So Tim, for us folks that just kind of look at the headline number, when am I going to see a ISM manufacturing number north of 50? When do you think we're going to see that and see a little bit of growth in the manufacturing economy?
I think it's very possible in March.
Oh, okay.
I've been saying that for the last 3-4 months. It's very possible that we could see it over 50 in March. The seasonal factors are an interesting thing. I'm a big believer in seasonal factors, but we had 3 years of no seasonality. And those 3 years are now factoring into our seasonal adjustment factors. We had, for instance, on the new order side, we actually upped the January new order number up 4.2 points in January, and we're now deducting 4.3. So there's some real volatility going in here because of what happened in the pandemic. These are carryover effects. But so look at both elements, look at the seasonal factor, look at the non-seasonal factor. We're definitely heading in the right direction. And I think the other thing here is on the production side, we're generally stable to the prior month. So revenue continues to be stable, which is good. We continue to take headcount out to match the future projections, at least within the next 6 months. We're running at about a 1-to-1 hire to force manage ratio, with half of the force managed activity being layoffs. So people are a little bit more urgent in eliminating the headcount compared to where they were in September, October.
Yeah,
I think that's all positive. And then for the first time in many months, I think 16, the supply base is now stiffening up. For the first time in many months, we've now gone to an environment where the suppliers are struggling to deliver. So that's all positive. It means demand is aggregating at the lowest level, and we're now starting to feel the impacts of it.
So this is why we love having Tim on, because you look at the headline number and we're
to
all like,
throw in Italian.
this isn't good here. And then we get the idea and we get the real data behind those numbers. So maybe when Torsten Slok says the economy is better than expected, maybe that's true. Tim, I know you're not an economist or a Fed official or Torsten Slok, but is the economy better than we think?
Well, I think, Alex, you and I have talked about this for many months now. Back in the August timeframe, I think in September, I came out with the declaration, I think we're in the trough, and I think we've been in the trough since August. And the thing I didn't have any insight into is when are we going to climb out of it? Then we did our forecast back in December before Chairman Powell released his predictions on 2024. The most important one being I'm pretty much going to cap out increases. And then by the time we get to 2026 sometime, I might get to the 2%. So at that point, we already had a very positive forecast for 2024, and that just provided really good tailwinds to help us through. And then, last month I said, I think we've now started to climb out of the trough, and I think this month supports that. It's unfortunate that the seasonal factors are so fluid here, but that will all stabilize. March and April are really strong manufacturing months. We probably will have significant seasonal factors to overcome. I think, like I said, we're not on a huge ramp up here in terms of expansion. It's going to be slow and gradual, but we're going to be expanding nonetheless. So I think we'll probably break the 50 mark in March, April for sure.
Hey, Tim, any particular industry out there leading the way, or is there any industry kind of holding back this U.S. manufacturing?
Yeah, thanks, Paul. So, the one I've been watching for 3 years now is chemical products coming back to an expansion mode because they support the other 17 industry sectors. Chemical products is positive. It's expanding at about a 51, 52 in the month of February for the first time in many, many months. But we've had 5 or 6 months of improvement in chemical products. So that just continues to support the story. And then also in the month of February, fabricated metal products, which is another feeding industry sector. They generally don't sell anything direct to the consumer themselves. They sell it to other companies that then convert it and sell it. That's one of our strongest industry sectors for the month of February too, in the positive territory. I think the number was 51, right. 52. So two of the big feeder industry sectors that support growth overall are in the positive territory. I think that's a very good sign. Yep. Transportation has gotten a little bit weaker than it has been. We're still expanding at a 50 and some change, okay? Food and beverage is contracting. It's probably, of our big 6 industries that we follow, it's the one that's probably the weakest, but right. I've come to learn that there's a real seasonal factor in the food and beverage industry, and we're at the bottom end of that seasonal factor now. Yep. They did really well in Q4. They've done really weakly in January, February. They expected to. That's our number 3 industry sector. So I would expect by the time we hit April, that's going to come out of it's going to pass 50 and move on, and that supports the whole PMI expansion over 50 in the March-April timeframe. Yep.
Hey, Tim, thanks so much. You know what? I'm going to give you an unsolicited room rater here. Your room rater in the background, it's fine. But the fact is, you're in Miami, Tim. We should have the background be like the ocean or your yacht on the intercoastal waterway. So if you could work on that'd be great.
It's even better. I'm in Jupiter.
There you go. That's what I'm talking about. Golf course then. Tim Fiore, thanks so much for joining us, chairman of the Manufacturing Business Survey for the Institute for Supply Management. Again, headline numbers not looking so great, but if you go under the surface, Tim's suggesting there's some strength out there. So appreciate his time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get back to some of the eco data at the top of the 10. University of Michigan sentiment, the final read for February coming in a bit lighter. Current conditions revised lower as well, and expectations revised lower as well. We want to get to the bottom of it. Joanne Hsu, University of Michigan Surveys of Consumers Director, joins us now. The revision lower, Joanne, what happened there?
Essentially it edged down just a little bit. It was not much of a change at all. And essentially we should interpret this as moving sideways between January and February. Essentially, consumers haven't really noticed any material changes in the state of the economy since the start of the year. And that comes through in our data. At the same time, it's also solidifying the really enormous gains that we saw in December and January. We're still almost 30% above where we were in November. That hasn't really changed even with this little wiggle this month. So consumers feeling better than last fall, feeling about the same as last month.
Yeah, I guess a lot of folks, Joanne, right now, given some of the inflation data we saw in January, CPI and PPI and so on, maybe concerned that maybe inflation's coming back into this economy. Are you seeing that in any of your survey work?
No, consumers broadly have felt pretty assured that the slowdown in inflation is going to continue. The data that these new inflation numbers came from comes from reflects consumers' experiences last month. It comes in at a lag, so consumers already notice those prices around them and any changes in prices. Last year we were seeing quite a bit of volatility, seesawing in inflation expectations in January and February. Exactly the same.
So, Joanne, what are we going to be looking for the preliminary read then for March? Like, what are going to be like the standouts that you're looking at?
The main thing we wanted to look for in the months ahead is whether this 30% gain that we saw in December and January, whether that's actually going to stick, given how dramatic those increases were. So far, the February read confirmed that. Let's see if that stays put in March and April. And, as mentioned, inflation expectations absolutely top of mind for consumers.
All right, very good. Hey, Joanne, thanks so much for joining us. Really appreciate it. Joanne Hsu, Surveys of Consumers Director there at the University of Michigan. We had some data come out there today.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.